Hey everyone, welcome back to the channel, which is all about income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. And today's video, I will talk about the video that you guys voted for, how to maximize tax efficiency in a Canadian cash account and the non-registered account. So taxes is definitely not my favorite topic to discuss, but I'm a man of the people. So if that's the number one thing you wanna hear me talk about, not a problem, we'll discuss it. So in this video, I'm gonna talk about the tax implications in a non-registered account. So we'll talk about that, and then I'm going to give you my top 3 tips to maximize tax efficiency in your cash account, right? TFSA, RSP, very easy. It's all, everything in there is gross tax free, etc. So, the non-registered account or the cash account is really where a lot of things are up in the air and people have questions. What's better? Is it dividends? Is it capital gains? What's more tax efficient? What should I put in there versus a TFSA? So hopefully this video will help you. And by the end of it, you'll be a tax expert. So we're going to look at a few things in this video. Number one, before we do anything, we need to understand the main sources of income in Canada, and we'll break it down into 3 categories. Once you understand that, which is the key thing, then I could share with you my top 3 tips on how to maximize tax efficiency in a cash account. Let's get to it right away. All right, everyone. First things first, we need to understand the different sources of taxable income in Canada. I actually made a video touching on this subject. It's my tax video part 2. So if ever you want to take a look at it, and I'll briefly just summarize what I say in this video, but you could always check out this video. And by the way, I do have a playlist. So once you go on my channel, click on my channel name and you click on playlists, I have a playlist just for taxes, investing taxes explained. So if you click here, you'll see all of my tax related videos, part 1, part 2, Q&A with my accountant. And I even have 2 videos on rock. So just to let you know, but basically in this video here, taxes part 2, I basically show how the breakdown of the different sources of income in Canada. And if you really think about it, there's pretty much, I'm simplifying it here. And another thing I want you to make sure you understand, I'm not a certified accountant. So everything I say in this video maybe is not 100% accurate, but I'm pretty sure that it's fairly accurate. But of course, always consult an accountant, a CPA, if really you want to be 100% sure of the information. So in Canada, everyone, there's basically 3 categories. Okay, this is what I show in the video. So there's interest income. So interest income, or the first category here, this is pretty much the worst taxed category. Your salary would fall under this category. If you own an apartment building, rental income would fall under here, and interest income. So interest income is what you get from GICs, from bond or fixed income investment, government bonds, high yield corporate bonds, etc. It's usually interest. That is the worst. Okay, that's category number 1. Category number 2 is going to be dividends or eligible dividends. These are going to be dividends from a Canadian corporation. So if you hold Bell stock or TELUS stock or TD stock, whatever, the dividend counts as an eligible dividend. And that's taxed a little bit better, definitely better than interest income. This is basically just your marginal tax rate. That's basically it. Dividends is going to be better because there is a federal and provincial dividend tax credit on eligible dividends. And I won't go into detail on how this system works. It's actually fairly complicated and really annoying to understand. It's called the gross up system. But I'll talk a little bit about it in a second when I show you everything. But dividends are definitely better than interest income. Then the last category would be capital gains. So capital gains in Canada is basically, when you buy a stock low and you sell it high, you make a capital gain. That's a capital gain. But income could also be considered capital gain. Okay, so a lot of the stuff that I talk about on my channel, the products, the covered call stuff, the option premiums generated with those covered call ETFs is going to be capital gains income. So it's very, very tax efficient because only half of it is taxed. So if you make a $1,000 capital gain, $500 bang goes right in your pocket, and the rest, the other $500, will be taxed according to your marginal tax rate. So it's literally 50% better than salary income, interest income, etc. Now there is another category called ROC, return of capital, which has a lot of misconceptions. A lot of people think it's bad and blah, 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 blah. It's not bad. There's good rock, there's bad rock. And I do explain it in my rock video, which I strongly suggest you check out, this one right here, where I explained it in detail. But essentially, I like to put rock or consider rock in the same category as capital gains, because essentially, although rock is not taxed now, it lowers your adjusted cost base or your share price, which kind of means it's basically deferred or delayed capital gains. So just to make our lives easier, everyone, these are really the three categories: capital gains, eligible dividends, and then there's the worst one, interest income. So a main question I get all the time is, which one is better between, we know interest is the worst, but between dividends and capital gains, which is more tax efficient? I get this question all the time. Now this example, and I apologize for not making it clear in the video here, this example is actually for someone in Ontario that's in the highest tax bracket. Okay, because the difference, how dividends is taxed versus capital gains, really depends on two factors: your province and your tax bracket. So this example is showing someone in the highest tax bracket in Ontario here, 49.53%. So the best way, so this is the first thing we need to understand. So now that you understand the three categories, right? There's interest, which is the worst, there's dividends, eligible dividends, and there's capital gains. Of course, there's rock, but we'll put rock with capital gains just for argument's sake here to make things simple. So now the $1 million question is, what's better, capital gains or dividends in a cash account? The answer is it depends. It depends on your province and it depends on your marginal tax rate. So let's look at Ontario. I'm on taxtips.ca here. And this is the 2022, this is the combined federal and Ontario tax brackets and tax rates, okay? So this will tell you which is better for you. You have to remember that it's different for everyone. What's better, eligible dividends or capital gains? Well, it really depends on your province and tax bracket. As you could see here, if you're making less than $46,000 in Ontario, or under 50,000 here, you could see that what's taxed on capital gains, it's only 10%, whereas eligible dividends is taxed minus 6%. So it's really, really, really good. And then as you go up in tax bracket, they start narrowing. So what this basically says, everyone, you could see here that once you're at over 95,000 in Ontario, over 100,000, you could see that starting at 100,000, if you make 100,000 in taxable income in Ontario, well, capital gains is taxed better than eligible dividends. But if you're making less than 100,000, well, dividends are taxed better. And it's pretty much neck and neck here. But as you could see, the lower you go, the lower tax bracket you're in, and this goes for every province, by the way, the more eligible dividends will be taxed better than capital gains. So it's very important you understand that this example here is just an example in Ontario at a 49.53. Here it is, 49 point, well, I guess it went up. But this is actually kind of almost the highest tax bracket here, right? So this case is really specific to someone in Ontario that makes a lot of money, basically. But if you're in Ontario and you're making between 50,000 and you're declaring between 50 and 80 grand a year, well, then eligible dividends is better than capital gains here by a little bit. And the more you go up, the more it starts narrowing. And at one point, capital gains becomes better taxed than eligible dividends. So there is your answer right there. This is what's really important to understand, everyone. Look at the chart where, from the province you're from, because Ontario is completely different in Quebec. Where I'm originally from in Quebec, the tax rates are completely different and they're actually much higher than Ontario. So you see here, if you're making 50 grand, less than 50 grand, you're paying 16% tax capital gains, 11% tax on eligible dividends. Meanwhile, in Ontario, it's only 14 in 6, or sorry, it's 12 and minus 1. So this is why in Ontario, eligible dividends are very, very, very desirable if you're making only 50 grand or declaring only 50 grand, because you won't even pay taxes on them. You'll even get a tax credit. But in Quebec, you're paying 16 on capital gains and 11 on eligible dividends. This is why, I get mad every time I see this, because I was from Quebec. I couldn't believe the difference. And just for, to let you guys know, before, looking into moving in Panama, we were actually thinking of getting out of Quebec for this reason. Because if you're financially independent and your only source of income is dividends and capital gains, well, you're much better off in Ontario than in Quebec. And in BC, every province is different. In BC, they have their own numbers as well. It's also really, really good in BC. It's actually maybe better than Ontario. So BC, if you're making 86,000 or less, you're barely taxed anything on eligible dividends. But as you could see, the more you go up in tax bracket here, the more it starts narrowing. And at one point, the capital gains will be more tax efficient than eligible dividends. But that's only in the higher bracket. So that is the number one important thing to understand, guys. Two things, right? The three sources of income. Interest is obviously the worst. No matter where you check, interest would fall under other income. So no matter what, interest is the worst. But between capital gains and dividend, it depends on your tax bracket. If you're in a really high tax bracket, capital gains is going to be the best. If you're in a lower tax bracket, dividends are going to be better. So that is the key, everyone, to understand. Now let me tell you my top 3 tips on how to maximize your tax efficiency, and it will make complete sense to you because of what I just explained here. So there you have it, everyone. I'm sure you're a lot less confused now. Again, make sure to check out my tax video part 2. I go into detail about how you could actually find the sources of income from funds or from ETFs. You could actually find all that information on the fund's website. And on top of that, if ever you still can't find it, don't forget that for every single fund that you get a T3 statement at the end of every March, the end of every tax year, right? So usually they come out in March, and the T3 statement will tell you, how much of the distribution you got is interest, how much is eligible dividends, how much is ROC, how much is capital gain. So you don't have to worry about trying to figure out yourself. You get a T3 statement every time. That's what you give to your accountant to do your taxes, and you can actually look at the information live on the fund's website. So if you go on, HYLD's website or ZWC's website, you could easily see the breakdown of the year before. So should give you a good idea of going forward. Does this fund give me a lot of capital gains, ROC, or is it more eligible dividends? For example, dividend 15 gives all, or the Quadravest ones typically give all eligible dividends, but then you have the Brompton ones where there's a lot more capital gains and ROC. So it's very important that you go check that out. So this brings me to the 3 tips I have. The first one is going to be extremely obvious. Obviously, don't get investments that hold bonds and fixed income or GIC. That gives interest income. So like we saw, interest income, one thing we could say for sure, that it's the worst. This is why I never invest in fixed income, anything fixed income whatsoever. I do not have it in my cash account. I can't stand fixed income, bonds. Not only do they always underperform equities or stocks long term, but they're less tax efficient. So this is why I cannot stand bonds or fixed income, and I don't want anything to do with it for that reason. And GICs also fall under that category. It's interest income, it's taxed the worst. So that's tip number 1, should be fairly obvious. Tip number 2 is understanding your situation. So using the information I showed you, look up your province, your tax rates, and determine for you which is actually better. Is it dividends, eligible dividends, or is it capital gains? And from there, you can make a decision on how you want to build your portfolio. So if you're in a lower tax bracket, if you're financially independent, you're making 50, 60, 70K, of distributions, you're in a lower tax bracket, well, then maybe eligible dividends probably going to be better for you, right? So you want to try to hold the stuff that gives more eligible dividends in your cash account, and that will be pretty much Canadian focused holdings, right? Because eligible dividends come from Canadian companies, so you can't expect much eligible dividends from an ETF that holds international stocks or US stocks or European stocks. But if it's a fund like ZWC or DFN, which has mostly all Canadian dividend stocks, you could expect most or a good chunk of it as eligible dividends. So you need to understand your situation. Look up the information, taxtips.ca. I'll put the links below so you can check it out for yourself. Understand your situation so you know what's better for you, eligible dividends or capital gains, and then you could plan accordingly your portfolio. Of course, if you have pension coming in, if you have a rental property, if you have your CPPs coming in, that all adds up to increase your tax bracket. And like we saw, the higher your tax bracket, well, eventually capital gains is going to be better. But look at it, because the median or the average tax bracket that people are in, dividends is pretty close to capital gains. So you got to determine your situation and plan accordingly. So that's tip number 2, to know what's better, capital gains or eligible dividends. And tip number 3, and this is probably the most important thing, everyone, is to maximize your tax efficiency in a cash account. Contribute to your RRSP. This is the most important thing. RRSP contributions lowers your income dollar for dollar. So it's a very, very, very powerful tool. It also offsets investment income, not just salary income. Okay, so the RRSP is by far the most important tool to have or to use to lower your tax bracket and to maximize your tax savings in a cash account. So that's definitely my number 1 tip. And my experience throughout the 10 years, and that's the most significant thing, because you could actually, by contributing to your RSP, it's possible for you to get in a lower tax bracket, which could make a big difference, right? If you get in a lower tax bracket, or even 2 tax brackets lower because you contributed to your RSP, and I know there's limits to the RSP and stuff like that, but most people, work all their lives and they accumulate a lot of RSP room and they don't use it all. But for those of you who have that extra room, even if you're not working, you could keep contributing to your RSP to get yourself in a lower tax bracket and pay less taxes overall. So that would be my 3rd and probably my most important tip. So in summary, everyone, to maximize taxes in a cash account, the most important thing is to understand your situation, what province you're in, and moving province could definitely be a huge benefit for you, especially if you're retired or you're financially independent. Moving from Quebec to Ontario, like we saw, can make a huge difference. So that's number 1. Number 2, don't hold bonds or fixed income. That's the worst. And number 3, keep contributing to your RSP. So I hope this video was informative. Give me a thumbs up. I would really appreciate it. If you have any questions, something's not clear, let me know in the comment section below. I'll try to get back to you, but I'm pretty sure this is fairly accurate. I'm not an accountant. Again, if you want 100% good info, talk to your accountant. Thank you so much for watching, everyone. I really appreciate it. Don't forget to hit that thumbs up button, that like button, and make sure you're subscribed not to miss out on my future content. Of course, hit that little bell next to the subscribe button so you're notified for any new content that comes out. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once, which is awesome. So this is a companion tool. It's a reference tool that will help you build your own portfolio according to your needs and goals, and it covers both the Canadian and American and US stock markets. So make sure to check it out. I have a video explaining from A to Z exactly what the product is. I showcase it, so there's no surprises. If you're interested, make sure to check out that video. Also, right there on my website on the homepage, I do offer a one-on-one coaching session with me. So this is a 1-hour Zoom call with yours truly for in case you need personalized help. I'll answer all your questions and I'll help you best I can. Just remember, I'm not a licensed financial planner or financial advisor. These are just going to be friendly conversation, right? It's just going to be my opinions. But if ever you're looking for that personalized touch, that personalized help, you could book a one-on-one with me. Make sure to check out the message on top of that calendar. That will give you a status of my bookings for that month. Also, we do have a Facebook group, great Facebook group, over 12,000 members. So make sure to join our community. The group is called Passive Income Investing, a nice Facebook group where everyone is sharing their thoughts and opinions and sharing their experiences. So it's a really nice group. We make sure to stay on top of the scam and the spams, and we delete those right away. So make sure to join our Facebook group. If ever you want something more personalized with us, you could follow us on Instagram. That's where we post more personal things on our adventures here in Panama. So follow us on Instagram if you want. And how do I always leave you? Continue to stay safe, continue to stay healthy, and of course, stay passive. See you next time.